I used to believe everything Dave Ramsey said when it came to retirement. However, I've since realized that if you've ever followed his advice, your retirement strategy is filled with false assumptions. And those same errors will leave you and your family with less wealth and less income than you deserve. I went back to one of the first videos I ever watched from him, and in it, he lays out his perspective about life insurance for retirement planning as if they were data driven facts. But instead of facts, I found 9 claims that vary from misleading to flat out manipulative. And those claims are exactly what I want to share with you today. My name is Slater Smith, Yale alum and founder of LLIS Financial. And here are the 9 erroneous claims that made me stop watching Dave Ramsey. But really quick, in case you're not familiar with the basics of life insurance, I have a free guide in the description that serves as a solid introduction. Now let's play the first clip.
If you take a $200 whole life premium per month,
Mhm.
I can buy the same amount of term insurance on that 30-year-old for about $10. So the other 190 would go towards cash value. That's the
Mhm.
actual data that's out there in today's market.
To start off, Dave makes 2 claims in one that whole life costs 20 times more than term, and that the difference in cost between the two is an extra expense for the cash value. Let's focus on the first one for now because the answer to the second half will flow from it. When I first heard the 20x factor on the rewatch, I was tempted to believe it. I mean, it's common enough knowledge that you get more death benefit per dollar with term than with whole life. But I decided to be responsible and run the fact check anyways. I pulled quotes from my primary carrier with the scenario of a 30-year-old male in need of $250,000 in coverage. More specifically, I looked at a whole life policy, a 15-year term, and a 20-year term. I'll put the prices on the screen for brevity, but we're not seeing anything like a 20x discrepancy. The whole life is only 8.7 times higher than the 20-year term and 9.9 times higher than the 15-year. And while that's still a meaningful gap, it's not nearly as severe as what Dave's describing. But I was still curious after seeing this. What if this was an older gentleman? To answer that, I ran the numbers again with a 50-year-old male, and the results I found might surprise you. Whole life was only 5.7 times the price of the 20-year term, and for the 15-year, it was 7.2x. The older you get, the more the prices converge. Why is that? Well, it's not because most of your premium goes to an overpriced savings account. It's because of risk. Term insurance prices use the same logic as whole life, but the cost is just a snippet based on your age. You see, there's little risk you'll die in 15 to 20 years when you're young, so the pricing is low. But as you age, your chance of death increases. This makes sense intuitively. If you're 60 years old today, the risk that you'll die by 80 are pretty similar whether you're getting 20 years of coverage or lifelong protection. That's why the prices look more similar the older you get. So, right out of the gate, Dave's claims about his 20x factor and paying extra for the cash value simply do not hold up. And if he's willing to over exaggerate the cost, it's worth asking what else he's getting wrong. We'll see more errors as he moves on to the returns of whole life, which is extremely relevant for your retirement plan.
Market. And so if I'm paying $190 extra for the life insurance in order to create a savings account, that's not the end of the world, but it's the rules of
Right.
the savings account that are the cash value. We'll call it savings. You said we're using it as a savings vehicle that are the problem. The
Yeah.
typical whole life policy accumulates zero cash value in the first 3 years. Have you noticed that?
Yeah.
So I have a savings account that I'm putting $190 in my example in per month.
Mhm.
And the first 3 years, I get zero. It 100% goes to the life insurance
Yes.
company.
Now, Dave says the typical whole life policy has zero cash value for the first 3 years, and that's a 1.2% return. This is what I'd call cherry picking. Let's look at my go to carrier to find out why. We offer 2 whole life products, one for protection, the other for accumulation. The protection policy, yes, has practically no cash value for the first 3 years, but the average growth rate is 3.8%, not 1.2%. The accumulation policy is a different animal altogether. Up to 80% of your year one contributions can be accessed immediately in the cash value. And the long term growth is the most impressive I've seen in the industry at just over 5%. I should add the cash value is tax deferred, but can be accessed tax free. So, depending on your tax bracket, 5% is the same as 6.4% to 7.9% returns in a taxable account, like bonds, certificates of deposit, or savings accounts. Would you turn down nearly 8% returns from a conservative asset? Of course not, because it would make saving for retirement just that much easier. And the thing is, anyone who wants these results can get them. It's easy. You could just send me an email, for example, to schedule a call. But instead of empowering consumers to pursue the most competitive products, Dave chooses to cherry pick from the bottom of the barrel. Then he frames that data like you have no other recourse. But the thing is, you do have options. All it takes is a little research and an ethical producer to hook you up with suitable coverage. And I believe wholeheartedly that you have the ability to do that for yourself. That said, let's move on to something that I find a little more reasonable.
All right. And so
Exactly.
these are $50,000 face value policies, right?
Yeah, or less,
Yeah.
I would say.
Okay. So they're small policies. Would you agree with
Okay.
me that a guy that makes $40,000 a year and dies, 50,000 is not enough to take care of his family?
Correct. It's not enough to take care of his
Right.
family.
If you wanted to replace a $40,000 a year income, you would need north of 400,000 invested at 10%.
Correct.
Yeah.
But I would say it's better than nothing at the
Better
same
than nothing,
time.
but for the same money he's spending, he could have bought the right amount of insurance if he bought term.
Right.
So I actually agree with Dave here. If you're in your working years, one of your main priorities is to replace your family's income should something happen to you. And if I'm being honest, whole life simply isn't good at that. Even though we've established whole life isn't unfairly priced like Dave claims, term is still the most cost effective option to get boatloads of temporary coverage. What Dave misses is that insurance doesn't exist for the sole purpose of replacing income. Whole life exists to create a legacy. This is a dimension of retirement planning that often gets overlooked. So, let me give you a concrete example. Say you want your grandkids to have $500,000 to split for college tuition when you're gone. Under Dave's strategy, your term will have expired years before you ever retired. Your only option will be to spend less during retirement. After all, you can't let your portfolio dip below that $500,000 threshold. But between inflation, market swings, medical bills, and not knowing when you'll die, you hope you'll have enough, but you don't know you'll have enough. A whole life policy eliminates all of that uncertainty. The death benefit is your legacy, locked in by one of the most stable financial sectors in the country. This is how I want my clients thinking. Grow your retirement wealth with the market, protect your working wealth with term, secure your generational wealth with whole life. Dave has the first two pieces, but two pieces alone can't finish the puzzle. And the reason why is due to a misconception we'll unpack in the next segment.
Okay.
Right.
They die with a $60,000 whole life policy with a $15,000 cash value that they've paid extra to build the cash value. With a $60,000 whole life policy, would you agree with me that the insurance company is going to send them a check for $60,000?
Only the 60,000. Yeah.
Exactly.
Correct.
So you paid
Yeah.
for a savings program, and when you die, they keep your money.
Nice parting gift.
That's why we think it sucks, man.
I see this myth constantly online because it sounds so convincing in a vacuum. But the moment you look at how other assets work, you realize how nonsensical it is. You have $15,000 saved inside an IRA and you die. Your family gets $15,000. You have $15,000 saved inside a whole life policy and you die. Your family gets $60,000. You do the math. Which tool is best for generational wealth creation? The cash value isn't some separate account that the insurance company is desperate to steal from you. It's equity. And you're probably familiar with home equity. When you sell your home, you get the sale price, not the sale price on top of however much equity you built up. The equity is just how much of the house you own. Everyone knows that, so nobody calls home equity a scam. The same principle applies to life insurance. When you're alive, you can only use a portion of the death benefit. That's called cash value. And when you die, the full death benefit pays out. It's not some underhanded trick, it's basic financial literacy. And if you want to improve your financial literacy, I just want to reiterate then you can get a guide in the description that goes over the three main types of life insurance. At any rate, this ends the more quantitative portion of the video. Dave's last three claims are more philosophical, let's say, which is exactly why they are the most manipulative. For instance, listen to how he talks about life insurance companies.
So if you look in the skyline of the typical mid-sized city, would be two things: banks and life insurance companies. Santa Claus did not build those buildings. You did. Your money went to them. You chose for it to go to them. They didn't steal it from you, but their products are so profitable to them, not to you.
This is the weakest argument Dave presents, and frankly, it creates an unfair double standard. Life insurance companies should be profitable. That's a minimum requirement, not a red flag. If they didn't make money, they wouldn't be able to pay claims. And that would mean no insurance at all. Term, whole life, nothing. So when your family needs a payout, there'd be nothing waiting for them but a GoFundMe account. This rhetoric doesn't support term only gurus or whole life advocates. It just attacks an industry that's doing its job. And look, if we're going to use profitability as a reason to discount a product or service, that should apply broadly. Dave has built a very lucrative business. I saw that his net worth in 2018 was $55 million, dollars, and it's surely much higher today in 2016. Does that mean his advice isn't trustworthy? Of course not. If anything, it means his ideas have helped a lot of people, and I respect that. But you can't go around attacking an industry for being profitable while building a profitable company yourself. That's the double standard I'm talking about. And his next assertion is even easier to disprove.
So when we talk to a young man like Elliot who's selling whole life insurance, or an old man, we find the only people that believe that rhetoric, that line that
Hey, it's Future Slater here. I realized during editing that Dave didn't finish his sentence. I'm 99% sure that he was going to say that the only people who believe that rhetoric are whole life agents. He's said as much in other videos, but I don't want to put words in his mouth either. My response is still educational, so I decided to keep it in, but that being said, I apologize for the oversight.
It's not the case that the only people who believe in whole life are whole life agents. Focusing on retirement, since that's my niche, one study in particular comes to mind. A few years ago, two accountants from Ernst& Young, one of the big four accounting firms, released a report. Their goal, the title says it all: the benefits of integrating insurance products into a retirement plan. Let me just warn you, Dave wouldn't like what they found. Of the five portfolios they tested, term life plus investments produced the lowest retirement income and legacy results. What they settled on was that the optimal strategy would be to allocate up to 30% of your retirement savings into whole life insurance. Again, these are accountants coming to these conclusions, not insurance agents. That doesn't fit Dave's narrative at all. But that doesn't mean you can't implement the results of this study into your financial plan, because it's not just tax professionals who see value outside of term insurance exclusively. It's the wealthy. And we'll discuss this after letting Dave speak once again.
really what you've got to do is you have to follow the money. Be a fruit inspector. What's the fruit of the products? When we talk to multimillionaires and millionaires, we don't find them using payday lenders, rent to own, whole life insurance. We don't find them using rip-off finance products.
Dave says we should follow the money. And okay, I accept his challenge. Let's do exactly that. But I'll tell you right now that we'll arrive at a very different conclusion. One of the richest men in human history was John D. Rockefeller. Adjusted for inflation, his net worth today would be $30 billion. Now, there's a book out there called What Would the Rockefellers Do? The authors explain that the Rockefeller family has maintained their wealth throughout the generations by using, you might have guessed it, whole life insurance. More specifically, they fund policies for each generation. This guarantees that when one person dies, their wealth passes down to the next generation ad infinitum. And it's not just the Rockefeller family. J.C. Penney borrowed against his whole life policies during the Great Depression to keep his retail chain alive. Walt Disney also leveraged his cash value when banks didn't want to fund his now multi billion enterprise. And the largest life insurance policy ever written in the United States was for an anonymous Silicon Valley mogul in 2014. $2,001 million, not for temporary income protection, but to pay off inheritance taxes as high as 45%. And that, my friend, translates to permanent insurance policies like whole life. Speaking of which, as I said before, Dave is worth at least $55 million. I genuinely hope he gets some coverage in place to protect himself and his family from estate taxes like our tech CEO friend did. He'll really need it. But with that, we move on to the ninth and final claim. And this one is the most personal for me.
You do not want to read in the Bible what God does to people who oppress the poor. When you mess with the poor on purpose, screwing them, and you mess with widows and orphans, you don't want to be on that list in the Bible. It's not a good list to be on. You don't want to be on the wrong side of a financial product and be justifying it, well, it's better than nothing.
I consider myself a proud practicing Christian. I converted in 2020 after years of not knowing who God was. On October 30th, 2021, I was baptized. I go to church. I pray daily. I ask that my sins be forgiven. So when Dave invokes scripture to imply that anyone who disagrees with him on a topic as mundane as life insurance is going to burn in hell for scamming the widow and orphan, that's not something I can take sitting down. This isn't about intellectual debate anymore. This is just dogma. And you can't have a sincere argument with someone who has decided in advance that they have the moral high ground. You can see this in his views on debt as well. He uses the Bible to say that he wouldn't even take a 0% loan, as if it's some mortal sin to borrow some spare change from a friend until payday. In contrast, I believe that a loan against a whole life insurance policy is the safest, most ethical type of debt available in the US marketplace. And if you want to find out more on how to safely borrow against your life insurance to build wealth, leave a legacy, save for retirement, and pay fewer taxes while you're at it, you can watch the video that's on your screen now.